Welcome back to Investment 360. Well, there are a wide range of factors that can affect the performance of your investments, but the impact of the changing value of the rand is itself multifaceted. Despite this, having insight into the influence that changes in currency values have on investments provides opportunities to benefit both in the short and the long term. Adrian Saville is the CIO of Cannon Asset Managers. He joins me now to talk about the rand and a second subject that we'll be touching on, the disconnect between market drivers and valuations, the JSE getting ever higher despite the sluggish economy. But let's start with the rand, because that's kind of a good news story. Many South Africans are of the opinion that the rand is again now a one-way bet, that it will be falling indefinitely. You did some research to suggest that's not actually the case.
Well, we think that there are a number of reasons to believe the exact opposite, that there are various arguments that suggest the rand could be substantially stronger than the current 10 rand level. Not least of which is the fact that whilst many of the world's biggest central banks have been printing money with wild abandon for the last couple of years since the onset of GFC, the South African Reserve Bank has displayed the most remarkable discipline and has managed the currency impeccably.
Explain quantitative easing, because wherever one talks with people from the investment world, it's thrown out, QE, as though it is something that is very scientific and very well put together and measured and thought and processed.
Yeah.
What's quantitative easing in your mind?
If you are the United States, you undertake a policy called quantitative easing. If you are Zimbabwe, you undertake a policy called printing money. They are essentially one and the same thing.
So what Governor Gono did in Zimbabwe to get hyperinflation is very similar to what America's been doing.
There's just a difference in terms of the magnitude. Obviously, Zimbabwe printed money furiously, and we've seen other examples of where furious printing of money leads to massive inflation. You can go back to Germany in the 1930s or some parts of Eastern Europe just after World War II, Latin America in the 1970s, 1980s. Quantitative easing, as we see it today, is in the same form in that it reflects or represents the printing of money. But the term quantitative easing, I suppose, does suggest that there is a greater discipline and a more scientific approach.
Is there?
Look, I'm on the side of the cynics on this one. I'm yet to see a case where wild printing of money or extensive printing of money, perhaps wild is unfair, extensive printing of money doesn't translate into inflation. And if you have an economy of a given size and you print substantially more money in that given economy, then it has to follow that the same money is chasing fewer goods. And the net result is inflation.
Why hasn't it happened? I'll take you back to Berkshire Hathaway this year, where even Warren Buffett said he was flummoxed. He could not have, doesn't understand why, with all this printing of money, inflation has not risen yet.
I think that's a great question, and there's a couple of factors that are at play here. The first one is that whilst the Reserve Bank, whilst the Fed, the US Central Bank or Reserve Bank has printed money, it's gone into the banking system and then it's stalled in the banking system. So the banks haven't on-lent, which means the typical credit extension that is associated with the printing of money hasn't come about. There has been some credit extension, but not wild lending that you would conventionally get. The second, I'm going to be cynical again, and my cynicism says that there is inflation, and it comes in two forms. The one is that certain assets have displayed remarkable inflation. The oil price in 2007, 2008 was $30. It's now $100. The gold price has ramped up materially. So the price of commodities has lifted substantially. I would describe that as inflation. And the second is that I think in the US inflation is underreported. And so there is more inflation than we see in terms of official sort of headline inflation.
Adrian, it's just to bring it back to the rand. The rand, as you said in the beginning, here's a commodity that's been well controlled. You haven't created a whole lot more of it. The major trading partners have been doing exactly the opposite. If you take a 3 to 5 year view, are you suggesting then that the rand in fact might be stronger at that point than it is today?
It may well be, and one of the greatest guides on currency, currency is notoriously difficult to forecast over almost any period. But if you allow for 5 years, you should have enough time for economic forces to play and for political forces to rinse themselves out and sentiment to be washed out of the system. And if you use purchasing power parity, which I will argue to you is one of the clearest guides on currency, purchasing power parity simply says that if a basket of goods costs so much in South Africa, 10 rand for this basket of goods, a Big Mac index, and if the basket of goods costs $1 in the United States, then the exchange rate should be 10 to 1. And using that tool, purchasing power parity, we estimate that the rand is more fairly pegged at about 6 rand to the dollar.
Well, that's an interesting long-term view to start working into your portfolios. The other bit of research that you have done recently is having a look at the JSE hitting new records despite all the economic, not all, but most of the economic news being glum. I was fascinated by your unpacking of the index itself, or the all-share index itself, which is hardly what many people think a reflection of the whole market.
The index is dominated by a small number of large companies, as almost any capital-weighted index would be. In the case of the Johannesburg Stock Exchange in the last 12 months, almost all of the lifting has been done by just a handful of large loved companies, which means much of the acclaim of these substantial returns is not really broad-based and well-founded, but rather anchored in a small basket. Perversely, the rand has a lot to do with this, because currency has translated into companies like SAB, Naspers, Richemont, which have substantial offshore earnings and or offshore assets. Translating those back into rands, you get a lifted share price.
So if you take the big two out, SAB Miller and Richemont, if you had a portfolio of shares and you had the market generally accepting those two, you left those two out, how much would the difference have been?
Well, I think if you look at the all-share index over 12 months, in our report, the 12-month return is in the order of 27%. If you take just the two biggest out, the number drops to just under 20%. And obviously the further out you push to capture more and more of the stocks, the more you can explain away. But in essence, about 10 companies explain almost all of the JSE's return.
Isn't that a dangerous situation? Because if those 10 companies have been outperforming, and if they just have a normal year, then the reverse that would cause in the index generally would be quite serious if you heavily weighted towards it.
Well, Alec, I'd say it's only dangerous if the company's outperformance in itself is gorgeous. It's what we all want. But it becomes dangerous when that outperformance is fed by overvaluation. And this is our concern about these large loved companies, is they have gone from being pretty richly priced 12 months ago, 18 months ago, to areas that I now want some more animated adjectives to describe this overvaluation. SAB Miller is a great case in point. If you take sort of conventional metrics that would explain the performance of a company, growth in revenue, return on equity, operating profit margin, if those metrics had lifted substantially in the last year or two, then you could say, well, this company's got to be worth a whole bunch more. But they haven't. The metrics that we see today are very similar to the metrics we saw 5 years ago, 10 years ago, 15 years ago. SAB Miller, however, has gone on to an enterprise value to EBITDA, which is essentially total value of the business against its midline profit, it now sits on a ratio of 23 times. As a value investor, I start to get worried at about 10 times. At 15 times, you wouldn't see me, and at 23 times, where it is now, this is remarkably stretched, and I don't think it represents investment opportunity. I think it represents risk.
So Mr. Market is quite exuberant when it comes to
Mr. Market's in a
stocks.
very good mood about these companies.
But he can change.
And when he changes, he becomes grumpy very quickly. Now, where could I be wrong in this? I could be wrong in that the drivers, the financial or fundamental drivers, have lifted permanently. So that SAB Miller is going to start to produce, or Richemont is going to start to produce much better return on equity, much higher permanent profit margins. And/or they could be about to walk into an arena in which their profit becomes substantially elevated. And that 23 EV EBITDA falls to 10 times, which is rational. But I don't see either of those coming about.
If you overlay your view on the rand, or your longer term view on the rand, then it becomes perhaps even more disconcerting, given that those two stocks in particular and some of the others have been boosted by a weaker rand.
Absolutely. Although given my earlier observations about the impossibility of forecasting currency near term, it may well be that the rand goes to 15 to the dollar because of perverse sentiment or some unanticipated event, war, and emerging market sentiment runs away. It could transpire that the rand goes to 15 to the dollar, in which case this 23 EV EBITDA would unwind
look
quite
wonderful.
quickly. Yeah.
When you're in the investment game, though, rule number 1 is don't lose money, and rule number 2 is don't forget rule number 1. That, I guess, is what's shaping your views here.
I think that the single biggest, or the point of departure in investing, I don't think is about how much upside is there in this, but rather how much downside is there. And in the worst case, you have permanent destruction of capital, and no subsequent brilliance recovers you from permanent destruction of capital. 100 times 0 is 0. So I think your rule 1 and rule 2 there are absolutely spot on. And what we see here is, whilst there may be some upside, the risk that you're taking, the multiples that you're paying to participate in that upside, to me seem speculative in nature.
Adrian Saville, thank you for coming through to the studio today. And that was Adrian Saville, Chief Investment Officer of Cannon Asset Management. And that's it for Investment 360 this evening. Remember, you can follow us on #Investment360 and